Okay, good morning, everyone, to the last day of the 60th PES annual conference. And we continue with the workshop presentations this morning. So you are in session E4 for this morning on financial economics and trade. I'm sorry, I forgot to introduce myself. I'm Peter Yu. I will act as the moderator for this session. No? So I am actually a faculty member of UAP, and I'm currently in one of our rooms here right now. So we have three papers this morning, and I'd like to ask the presenters to. So we'll budget around 20 minutes, no, each for each presentation, and then when you get down to the last 5 minutes, we'll probably have a parang message to you, no, that you are that you have 5 minutes left. So without uh, further ado, let's get the papers underway. I'll start off with the paper titled Banking on the Future, Measures, Drivers, and Benefits of a Cashless Economy Amidst COVID-19. This paper is co-authored by Mr. Ethan Lee, Josh Ong, Ms. Kathy Salazar, and Mr. Scott Yamson. But I guess Mr. Ethan Lee and Kathy will be co-presenting this morning. So if we are ready, Mr. Lee, Ms. Salazar, you may start presenting.
Sure. Thank you, Doc. I'll share my screen now. Can my screen be seen?
Yeah, we can see your screen. Your audio is also okay.
Okay. All right. Thank you. Okay. All right. In an increasingly digital world, money has moved away from our wallets and into our phones. We see this in the many e-wallet applications we own, in the many online banking access platforms we avail of, and even in the many investment tools we are exploring to earn off of. Fintech has indeed arrived. And while it will continue to grow into the future, it is important to realize that one of its greatest drivers in recent past must be the COVID-19 pandemic. But how exactly is this so? What has the pandemic done to improve fintech in the country, to help Filipinos avail of financial services? Good morning, everyone. My name is Ethan, and today with me is Kat. And today we'll be presenting to you Banking on the Future, Measures, Drivers, and Benefits of a Cashless Economy Amidst COVID-19.
Now, with fintech being a relatively new industry, there remains a large gap in existing literature when it comes to understanding the industry and their implications to each other, and economy and society. As such, our paper aims to determine the implications of the pandemic on the ability of banked and unbanked Filipinos to access financial services. Specifically, it seems to determine the evolution of financial technology in the country, the banking industry's response to fintech, and socioeconomic effects of fintech to Filipinos. Now, the findings of this paper provide significant contributions to the digital financing sector. For one, it will provide an assessment of the impact and current trends brought about by the pandemic on the industry and would specifically be beneficial to analysts, professionals in the industry, and financial institutions, as the dynamics, conditions, and changes will be tracked and analyzed, providing possible changes and risks in the future. Second, this paper will also determine bottlenecks and opportunities for further development of the said industry. And leading into that is this paper will also provide recommendations to policymakers, public officials, and financial institutions alike to fasten the growth of financial literacy, accessibility, and inclusion within the sector. Now, given that these opportunities will be identified, this can be the basis of such recommendations along with benchmarking to different states with similar circumstances. Now, ultimately, this paper will significantly contribute to understanding and developing the country's digital financial industry.
Now, in fulfilling the main objectives of this paper, it would be good to first review ideas that past and recent literature have brought about regarding the financial sector and the fintech industry of the Philippines. So let's begin with the financial sector. According to the World Bank, a country's financial sector can be defined as a system of interplaying institutions that deliver related financial services. This diagram shows exactly this, with these varying institutions providing specific transactions or services to facilitate efficient economic transactions. With this framework in mind, the health of a country's financial sector can now be measured in four different ways: financial depth, accessibility, efficiency, and stability. In terms of financial depth, the Philippines has relatively been quite small, and this is evidenced by the fact that the Philippines has consistently lagged in providing domestic credit to private corporations, reaching an all-time low private credit to GDP ratio of 75% in 2016. Unfortunately, the same can be said for accessibility, with the Philippines historically lagging in getting individuals to open accounts in commercial banks. Nevertheless, this is improving. In terms of financial efficiency, the Philippines has been doing relatively well, but the country still lags in its stock market turnover ratio against countries like Thailand and Vietnam. In terms of financial stability, the Philippines is also doing quite favorably, as a Z-score of 15.7 indicates a fairly stable market relative to Singapore and Malaysia. As such, in the end, the Philippine financial sector is continuously developing and can be thought of to be above average among other emerging markets. Nonetheless, it remains on the lower side among emerging Asian economies, according to the IMF. Now, having talked about the financial sector of the Philippines, we can now look at what exactly is fintech. Well, according to the Corporate Finance Institute, fintech is essentially an integration of technology within existing financial systems to disrupt traditional practices. This is an interesting definition that has caused regulatory issues across the globe. For instance, PayPal is a fintech company, but it isn't regulated like a bank, despite its resources being great enough to categorize it as so. Regardless of this fact, however, fintech adoption across the planet has been rampant. Global investment continues to increase, and consumer adoption has improved by leaps and bounds for several markets across the globe. The two economic trends responsible for this are essentially a growing need for digital transformation and a general trend towards cashless economies. This has been brought about through the convenience that fintech brings and with how that allows the market to bring more businesses into that sort of convenience. Now, the last portion of our review of related literature looks at the social implications of developing a good financial sector. This can be broken down into financial literacy, financial accessibility, and financial inclusion. All of these measures are goals that the Philippines continues to work on, but is unfortunately lagging in. It is with this in mind that there is a greater need for development in finance so as to improve the lives of Filipinos everywhere. Now, to supplement our review-related literature, we also engaged in an SCP model to explain the fintech industry of the Philippines. And this is precisely what follows. In our research, we found that the fintech industry can be considered an oligopoly, with most emerging categories within fintech boasting only a few firms and only a few firms that are dominating. One can see this especially in categories like neobanks, credit scoring, and even e-wallets where GCash and PayMaya dominate the market. Overall, however, this assertion must be made in consideration of BSP regulation and the banking industry as well. Now, moving on to industry conduct and industry performance, several interesting things can be said as well. In terms of conduct, most fintech companies are indeed immersed in product differentiation and product innovation, which has precisely led to entities like BSP and SEC having to take a more proactive approach to protecting public interests and regulating the industry. Nevertheless, this innovation has allowed for improvements in performance as the years have gone by, with more fintech startups emerging and financial, regardless of a lack of digital readiness and financial infrastructure in the Philippines. As such, at the end of the day, with the government's desire for financial inclusion, the Philippine fintech industry is expected to continue playing a critical role in revolutionizing the way financial services are being offered in the country.
Now, having said all of that, we can now move on to our core methodology in creating this industry paper. And now, in answering the research question raised and filing the missing gaps in existing studies, a series of hypotheses and respective sub-methodologies to prove or disprove them were raised. Now, these are summarized in the table presented in your screens in the next slide. Now, we posed our general question earlier on the implications of the pandemic to the ability of Filipinos, both banked and unbanked, to access financial resources. So after our initial data collection, we believe that the fintech improved accessibility and functionality of financial services for all Filipinos, letting them benefit in their day-to-day activities. Now, this general question can further be broken down into three parts. First is on mapping out the evolution of fintech based on the number of sectors and innovations. Researchers we hypothesized that there were more accounts and services that shifted to fintech instruments. Now, we aim to answer this question through performance indicators in the market, particularly the total number of accounts, revenue generation, and volume of transactions. Data that we primarily got were from Inquirer, Statista, GCash, PayMaya, World Bank, Bloomberg, and the Philippine Statistics Authority. All data were accessed real-time series analysis from 2017 onwards to the most recent information available to gauge how the data has moved as a result of the COVID-19 pandemic. Now, second question deals much more towards the effect of the arrival of fintech to the financial sector. Initial hypothesis shows that the arrival of fintech enabled more Filipinos around the archipelago now have more access to more tools and resources. Data used were on the expansion of the services offered and strategic responses of banks. So in particular, we explored the reactions of certain groups of firms as a result of the increasing shift of digitization within financial services brought about by fintech companies. So these interactions include e-wallet companies competing against each other, establishing key partnerships, securing exclusive platform transactions, or even expanding into a wider range of services. Meanwhile, the second set of interactions examine the responses of commercial banks in response to these developments. So these include updating their respective apps and increasing adoption of digital methods in their services. Now, we examine the product offerings of these firms and the points in time in which they were implemented. And in particular, we also look into the additional features of the two respective leading banks, which two e-wallets, which are GCash and PayMaya, and other features adopted by universal banks such as BDO and BPI. Now, lastly, one of the considerations of the overarching question is that the non-economic or non-financial implications of the pandemic to the sector. There exist societal issues surrounding this issue, so the researchers also wanted to bring to light and analyze these issues. So as such, the last specific research question concerns itself with the social implications of the rise of fintech. So we believe that the rise of fintech improves financial literacy and inclusion for both banked and unbanked Filipinos as they become more exposed to the aforementioned variety of services and information. So the researchers primarily got the indicators from BSP and the World Bank. So particularly financial access, account ownership, usage of financial products and services, and digital finance. So the next two tables presented, these are all of the indicators used for the study. So first is being economic indicators related to the financial performance and managerial decisions taken by the firms, both commercial banks and e-wallet providers. And second, being social indicators related to the consequent effects of the fintech industry on key goals such as literacy, accessibility, and inclusivity.
Now, after collating and organizing a data, you're able to acquire a number of findings. So what follows first is our findings for the first guide question. How has fintech evolved in terms of the rise in the number of sectors and innovations? To answer this, we first looked at the performance of the top two e-wallets in the country today, GCash and PayMaya. As seen here, GCash perhaps experienced the largest growth over the duration of and continues to grow now. Specifically, at the end of 2020, GCash saw its base of registered users grow to around 33 million individuals, a 65% increase from the 2019 figure. Revenue and annual transaction value likewise improved by around 266% and 177% respectively. PayMaya likewise saw tremendous growth due to the pandemic, given that at the end of 2020, PayMaya saw its consumer base increase to 28 million individuals, only slightly below GCash in share. The company also saw tremendous growth in revenue and annual transaction value. Now, after looking at these e-wallets, we also looked at the adoption of digital services by two top commercial banks, BPI and BDO. Data from the annual reports provided by BPI indicate that at the end of 2020, the bank had facilitated around 1.8 billion pesos worth of online transactions, a huge 26% increase from values reported in 2019. Along with this, BPI saw a 22% increase in BPI Express online accounts from 2019 to 2020. Interestingly, however, BPI still saw decreases in net income, with it dropping below 2017 figures in 2020. This is a prime indicator that despite digital banking playing more of an important role for BPI during the pandemic, a lot of its operations historically depended on more physical transactions. Moving on, like BPI, BDO also saw the need for more integration of digital services within the pandemic. As such, by 2020, BPO's digital transactions amounted to around 100 million pesos, a 58.7% increase than the amount recorded in 2019. The same sort of trend with BPI could also be observed with BDO, with regard to the number of registered users of this service, as BDO reported 4,600,000 more accounts in 2020, a 53% increase. Nevertheless, income for BDO followed the same trend as BPI, in that net income fell just slightly above that of 2017 and 2020. All this being said, fintech has indeed evolved throughout the pandemic, and the method behind such evolution lies in the increased usage of traditional fintech companies like GCash and PayMaya, and the increased integration of commercial bank giants like BPI and BDO. They ultimately have brought more Filipinos to the financial system. Now, with this favorable performance, however, of fintech during the pandemic, it is reasonable to believe that industry dynamics within the overarching and entire financial sector were bound to change as well. Firms needed to take on different strategies to help improve their standing in the market. As such, what follows are our findings that answers the second question. How has the rise of fintech affected industry dynamics in the market? So let's use GCash and PayMaya once again. As said, throughout 2020, both firms experienced massive gains in terms of both the number of accounts opened, the volume of transactions made, and more. This prompted both e-wallets to make significant changes to their business models, introducing many areas or new areas for competition. One such area would be price competition, with both firms leveraging their market power to induce brand loyalty. Aside from this, both firms also look to compete in value proposition, with both innovating to deliver product offerings to attract customers. GCash's main strategy was to build its existing advantages in creating new products like GInvest, GInsure, GLife, and even GLoan, all services that are probably still being used today in a popular manner. PayMaya has likewise opted to focus on developing its existing strength in its integration with Smart and its wide network of partnered institutions. It has thus been able to provide products like GigaPay, its PayMaya Mall, and even its very own digital bank, PayMaya Bank. Now, with GCash and PayMaya conducting such changes, traditional financial institutions have likewise strategically responded by either establishing their own platforms or integrating themselves into existing fintech applications. One can see this in the many mobile applications created by commercial banks and in the many digital banks that have also arisen. This has also emerged alongside partnerships with fintech companies like GCash, with companies like AXA, in providing insurance to customers everywhere. In the end, in answering how the rise of fintech has affected industry dynamics, 4 conclusions can be made. More touch points and partnerships have been made, more products and services are now being offered, more traditional banks have been improving their digital platforms and services, and more developments are occurring overall for the digital financial ecosystem.
So given that the rise of fintech had significant effects on the current financial landscape, it also brought about positive changes in the everyday lives of Filipinos. So what follows are the significant contributions of the more accessible fintech to the lives of the Filipinos, especially during the pandemic. So in terms of account ownership alone in deposit accounts, there was already significant improvement, as deposit accounts are considered as one of the most basic yet robust financial services. An increase in accounts, depositors, and volume show how wider penetration of financial services in general. Now, this made it easier for people to access financial services through new technological applications and online platforms. So much improvement during 2020 can be traced back to a shift of applications, banks allowing people to apply for accounts remotely and online. Now, this influx continued afterwards to the next years. So another important indicator is the difference between the amount of new deposit accounts with the amount of new GCash users over the years. Comparing these figures will provide insight into how unbanked Filipinos are now able to access the financial system and how more Filipinos see the digital finance as a more attractive option over regular banking deposit accounts. Results show 2 things. 1, GCash user base is growing at a rapid pace relative to that of commercial banks. And second, the pandemic has spurred more individuals to create GCash accounts relative to deposit accounts. Both insights imply that more unbanked Filipinos are now able to access more services within the financial system, primarily driven by digitalization. Admittedly, an increase in deposit accounts fail to consider the people who may have difficulty applying for these accounts, whether it be through the lack of money or documentation. So as they have this difficulty, these people shifted towards e-wallets. Almost 6 million more unbanked Filipinos were able to utilize e-payments for convenience in their everyday lives, as seen in the increase of active e-money wallet accounts. The use of e-wallets were extensive, allowing specific sectors in society to access and utilize financial services unlike before. Now, the access and usage of e-payments stemming from account ownership of deposit accounts and e-money wallets are reflected in the volume and volume of transactions in electronic fund transfers or ETFs. So in the country, the BSP has implemented the use of two ETFs in the national retail payment system, particularly PesoNet and InstaPay. So as shown on your screens, transactions in value and volume of for both ETFs significantly increased in over the past years, especially during 2020 onwards. While there is still a substantial portion of people not being able to utilize any financial services, surveys show that people are still gaining awareness and interest for digital banking in general. So as such, more growth is expected towards the market.
With all these findings in place, without a doubt, we can firmly say that the pandemic has positively impacted the ability of banked and unbanked Filipinos to access financial services. More Filipinos now are able to be integrated into the digital financial ecosystem, as fintech has become increasingly important, with GCash and PayMaya serving as prime examples, and as commercial banks continue to integrate digital products within their overall overarching business model. This must continue to occur, and what must be done in order for that to occur is that there has to be good collaboration between customers, e-wallet providers, and other financial institutions and regulators, so as to allow for a more comprehensive digital ecosystem within the Philippines.
Now, based on these presentations of our findings, we recommend the following with regards to dealing with the problems and challenges that are prevalent in the market. So first, we should integrate technology and financial literacy into digital finance. So while there has been an increasing trend to adopt digital financial initiatives, there are certain marginalized and underrepresented sectors of the population who may have difficulty in accessing or participating in the digital adoption effectively and efficiently. So to cope with this issue, we suggest providing more avenues for individuals to learn about technology. Second, we must improve telecommunications infrastructure so that we're able to grow and work hand in hand for wider penetration and accessibility. Third, the institutions themselves and the government should increase their support in financing the market. So given that we want to have an expansion of services, and while this is costly, we should look into other possible funding opportunities like IPO, looking into foreign investors, incubators, or accelerators to provide finances and other relevant support and training. Now, lastly, banks and e-wallets must coordinate with one another in order to support each other in integrating or linking their services together through partnerships to expand their product or service offerings. Thank you very much.
Thank you, Mr. Lee and Ms. Salazar, for your presentation. Let's have our open forum on all three papers at the end of this session. So with that, let me call the second presentation from our friends from the University of Asia Pacific. I forgot to mention that Mr. Lee and Ms. Salazar are from UNP also. So let me call now the second paper, Bank Competition, Concentration, and Financial Stability, Insights into the Emerging Markets of the Universal and Commercial Banking System of the Philippines by Dr. Joby Takanay, Ms. Micaela Merino, and Ms. Ella Leonido. I think Dr. Takanay will be presenting. Are you?
Yes, Dr. Dakani will be presenting, but she got disconnected and she's still trying to reconnect.
Okay, we'll give her a few seconds, siguro. If not, we may have to go on to Dr. Cruz, siguro. Let's see. I think yung co-authors niya are not around either, no? So it's just
No po.
Dr. Dakanay lang who will present. Okay, so I don't see her able to connect back. I don't see any connecting here. Erwin, are you ready ba?
Yes, I
To
can.
go ahead.
Yeah.
Sige. Yeah, well,
Yeah,
let
to
me
give
just
her more time.
introduce ano na lang si Dr. Erwin Cruz, who's with the Ateneo de Manila University Department of Economics. Had the pleasure to meet him on the first day in person, finally, at the PDS conference in Novotel last Wednesday. So Dr. Cruz's paper is on trade, and the title is an assessment of the new goods margin in Philippine exports to the EU. So this is by Dr. Erwin Cruz of the Ateneo. So yeah, Erwin, if you're ready to share your screen, and your audio is okay naman.
Let me try that. Okay, thank you. Sure. So, see my screen?
Yeah, I can see it. We can see it.
Yes. Okay. Okay. So I'll just go.
Parang nag-break up ka ata on the audio.
Straight in the presentation. Thank you very much, everyone. Hello. Hello. Can you hear me? Hello. Hello.
Yeah, it's okay now. Although the
Okay.
screen.
I'll stop my video, but I'll my screen. Okay.
Yes, please. It's okay now.
Okay.
Yeah,
Okay.
we can see the screen and can hear you. Okay.
Okay, great. Again, thank you everyone for making time for today's session. So I'll just go straight into the presentation. So so this study is basically an assessment of this indicator, like the new goods margin on Philippine exports to the EU, specifically after the GSP Plus program. So basically, the research question is trying to figure out if the as a result of the European Union's GSP Plus program, um, there was an increase in the diversity of basket of exports of the Philippines to the EU. With using this indicator, least traded goods, as an indicator of export diversification. So why is this quite significant or important? Basically, it's rooted in the fact that if a country has a diverse set of exports, or there are changes in the new goods margin, this is quite very much important for developing countries, and it's also an indicator that suggests that there is an increase or a rise in the competitiveness of local firms. And as you remember from our trade classes, that if you see um, um, uh, firms that are much more efficient, are that display more efficiency in producing their products. They're the ones who are actually exporting to larger and foreign markets, because in these foreign markets, they're the ones that they have a higher particular standard. So local firms that reach that threshold. Are the ones who have the capacity actually to export, because there are also all these related costs to exporting. So having seeing an increase in exports at the product level can suggest that there is an increase in competitiveness. And also related to that is the fact that if a country is less dependent on a narrow set of goods, then um, it will have is a bigger no, a stability in export earnings if your portfolio of export goods is much wider. Now, going back to the EU as a trade destination for developing countries, for those who are not familiar, as some of you know, the EU actually, as a group of first 28 and now 27 member countries, they have a harmonized trade policy, meaning when it comes to trade, it's all the same for all the member states, which means that there is a single rule book for trade for all of its members. And that's great, actually, if you are an exporting firm, because you are, there's only one rule book. And for developing countries, it's actually quite attractive destination because actually it imports a lot from developing countries, specifically non-fuel imports, more than the U.S. and China and Canada combined. And through its many arrangements, actually 70% of imports from developing countries already enter the EU with reduced and zero tariffs. It also has this special program like the generalized scheme of preferences, which is not only the EU has. There are other countries, developed countries that have this in support of developing countries, and these are it's a unilateral trade policy. And underneath the wider scope of the GSP program, there are two sub schemes. There's the GSP Plus, which the Philippines qualified for in 2014. And after it was, after the 2014 reform, and then there's the everything but arms sub scheme, which is primarily for designed for least developed countries. And so for the GSP program itself, and the Philippines, we the country actually qualified for this in 2014, and also that's after a reform of the program. And it's actually one of the eight recipients of this uh, uh, of privilege. And basically, whereas in the GSP program you have reduced reduced tariffs or preferences, with the GSP Plus, that is extended to zero tariffs. Okay, in a wide range of goods. And for this study, actually, I'm treating this uh, program as a liberalizing event. A country, or specifically the Philippines, uh, receiving this privilege, which will actually expire or end next year, 2023, and will be subject for a review. Um, as a trade liberalizing event, even though in other studies they may treat trade liberalizing event as, it's like a free trade agreement, like bilateral agreements. So the GSP Plus also is quite um, important for developing countries because precisely it is under the GSP program, and also so it has a developmental dimension, and it actually is rather coherent with the overall external policy of the EU with regards um, to developing countries, and that is poverty reduction. So if you look at the development policy of the EU, uh, they made a coherent or they aim at a particular focus, and that is poverty reduction. So this is a rather the GSP Plus program is very coherent with the overarching external policy of the EU with regards to developing countries. Okay, with the assumption obviously that that trade can contribute to economic growth, and help in poverty reduction, even though the links are not that straightforward. Okay, which is just as I mentioned, the links are between uh, poverty reduction and it's not that straightforward, but uh, this is something that we would like to um, uh, is relevant in this study. Also, however, with analysis of the GSP program in itself, most of the studies, especially obviously with developing countries, a lot have been inconclusive, or if there are positive results, it has been limited. And there are these studies looked at it as in a general um, overall or overall increases in like exports, but they also looked at a product level. So it's rather mixed. The results are rather mixed. With regards to analysis of the GSP program itself, the GSP Plus program after the 24 uh, um, uh, reform, there has also been few studies because precisely because of the recency. Okay, now really another part is the um, um, extensive margins. Okay, so what which is the indicator that I'm trying to focus on with this study. So growth in the intensive or extensive margins are, are, are observed or studied, after a liberalizing event. But and there are you have to look at the different definitions. Several studies would have different definitions for extensive margins, but for intensive margins it's basically looking at changes in your export volume for products that you're already exporting. Okay, so basically it's more of the same, after a trade liberalizing event. Whereas for extensive margins, you look at the change in the number of goods, right? Or a change in the number of destinations after a trade liberalizing event. So the one that I know this study is focused on is really much more on the change in the number of goods rather than the change in the number of export destinations after the trade liberalizing event. Um, and the indicator looking at is based on a paper or study by or the methodology by Kehoe and Rule, which looks at a country pair's least traded goods. And the least traded goods is formulated differently because in other studies, the new goods margin is basically after a certain dollar cutoff. So I think it might be like $20,000, which may not be um, applicable for developing countries because there are developing countries that produce that export a lot to other countries, to developed countries, but it may not be how do you say this? The absolute value may not reach that threshold, that dollar value threshold. So for Kehoe and Rule, they use this least traded good indicator. So if we look at the growth of the extended margin, using the least traded good as an indicator, then we could see an increasing. This would suggest increase or a rise in the diversification of exports, and also suggesting a rise in the productivity of firms exporting to that particular how do you say this destination. So as I already mentioned, for the methodology, I adapted methodology by Kehoe and Rule in determining in using that least traded good as an indicator, and trying to also part of that methodology uses this a certain computation for a base year. In this case 2014, which is the start of the GSP Plus program. So even if like the computation for this base year is not just like just 1 year, but it's actually the average of 3 years. So which means like 2012 to 2013 and 2014, because you may have like a zero exports for a particular year or a low value exports for 2014, but you may have a non-zero figure for the previous 2 years. So they take into account those 2 3 years and computed an average of those 3 years for to arrive at a base the base year, a particular base year. And the figures for this base here, they separated the products being exported into 10 different bins with the the last 10% as the least traded goods. But adapted it. It's like I didn't try to look at the other 9 bins because the last 10 bins, the last 10% or the least traded goods, the in the first bin is already enough. It's a sufficient statistic to arrive at what this study is looking for. Okay, so basically it's just a division of the least traded goods and the other traded goods. For the data set, I use CPI's BACI or BACI data set with using this particular revision. There's already a revised how to say a newer revision of with the HS codes of I think I can't remember the most recent ones, but I used the 2012 which has data, at least for the BSI data set, that includes 2014 and years before 2014. Okay, and I looked specifically just for the export values from the Philippines to the 27 uh, um, members of the EU plus the UK, because at this time, so I ended my study at around 2020. Even at and but with a special focus on 2019, because the 2019 figures are not yet how do we say this, distorted by the pandemic. It was not yet a pandemic year. So at that time, the the UK is still part of the EU and has not yet the single market. Okay, so I also included that in the study. Right. So basically, the new goods over here captures the low value trade. So it's not according to Kehoe and Rule. It's not um, it's not it's not it's not using a particular dollar cutoff, but it also like includes the ones that are below that dollar cutoff, which most developing countries would be exporting anyway. Also, I just need to clarify that the other studies that have used this methodology, there are not a lot, and most of the studies that have used this are between developed countries, and mostly free trade agreements, so bilateral agreements. So the ones that I've seen was one on Mongolia, and something that I did also for the Philippines, actually for the new members of ASEAN, and with Japan. Okay. Now, so what are the results of the analysis? As you can see, I did not use the 10%, but a near 10% for the baseline, precisely because if you say 10%, it would mean that you will cut the computation of two between two product lines, but you cannot really split the values um, of a product line. So it's either the product line is below or before the 10% threshold. So using this as the baseline of the least traded goods, um, uh, I looked at the evolution, after, from 2014 and then 2019. And as you could see in the original 6 members of the EU, and these are the members that the Philippines has had a longer trading relationship, because they were members of the European Economic Community already then. So they were already a single, there's already coordination with the trade policy at that time. You see a rise, which is good. It's a rise in the least traded goods here, in the share of the least traded goods, from near 10% to near almost 25% for Germany, 35, um, and then around 30% for Belgium, Italy, and France. Okay, so, and I also have to state right now that Germany and Netherlands also happen to be very significant entry points for goods with for the rest of the European Union, precisely because of their ports, Hamburg and Rotterdam. Now, what's interesting is for the other for these three countries, specifically Ireland, you have Ireland barely moving, from near 10%, and then going up to just 13%, right? So if you would remember from our trade classes, we could assume that that gravity and also the size of the economy has an effect to this, because Ireland is far off on the near the on the Atlantic, the farther side, and further from the main entry points for developing countries in East Asia, or Asia, such as the Philippines. Okay, so we could make that assumption. Okay, whereas for the UK, again, traditional partner, it's rather muted, around 25%, and also for Spain. What's the most interesting finding is the are the Baltic countries, the newer member countries. As if you're following developments in the EU, there in 2004, there were around 10 new member countries that joined the EU, mostly from Eastern Europe, and this includes the Baltic states of Lithuania and Latvia, which displayed a lot of a significant rise in the least traded goods. Again, this is not looking at the absolute value of exports being exported from the Philippines to Lithuania, um, but it's showing that there's an increase of new goods, yeah, from the Philippines going being bought, being patronized in Lithuania. And what's responsible for Lithuania is actually tobacco products, whereas for Latvia it was sugar confectionaries, sugar confectionery products. And then you have Slovakia, which is also a new member state. Finland, Sweden, and Austria are are slightly older members, but they have a smaller economy,
Sorry
right?
to interrupt lang, Erwin, if you can wrap up in
Yeah.
2 minutes.
Okay.
Your 20
Yeah.
minutes is up now. Thank you.
Okay. So that's the finding. So for these new and smaller countries. And just for the two more points. Czech Republic and Poland, they are actually have an experience an increase in absolute values of exports from the Philippines, and yet for the Czech Republic, the new goods margin is higher than that of the Poland. What this indicates or suggests is that with Poland, we're exporting more of the same, but for Czech Republic, we're exporting more of the new extensive goods. Czech Republic and Poland actually has overtaken Spain in exports to EU members from the Philippines. Okay. Um, Now, just to wrap up, like I said, uh, it's interesting findings is the fact that there are smaller changes from traditional export partners, larger changes from newer and non-traditional export partners. However, local demand is dependent on the export product growth is dependent on local preferences. As you could say, like Lithuania, they were importing more tobacco, and yet the neighboring Latvia was importing more sugar confectionaries. And also the method, as I saw in this study, is a bit unstable for certain, so there are data issues. So if you only have, like in the case of Bulgaria, which only had two export lines from the Philippines, then the results were not so reliable. So I end my um, presentation with that, and apologies for exceeding my time. Thank you.
Thank you, Erwin. If you have any questions on any of the papers, by the way, you can start typing your questions in the chat box, and then later on I'll get to those questions. So let's go to our last paper presentation for this morning. This paper is entitled Bank Competition, Concentration, and Financial Stability, Insights into the Emerging Markets of the Universal Commercial Banking System of the Philippines. This will be presented by Dr. Jovi Takanay, although she has co-authors Ms. Micaela Merino and Ms. Elia Leonida. Jovi, you have 20 minutes, so please keep your presentation to 20 minutes.
Yes.
Yeah.
Okay,
Can we
thank you
try
so
your
much.
audio?
Yeah.
Okay, yes, we can see your slides and audio is great. Thanks.
Okay, thank you so much. Sorry for the glitch. I should have been the first presenter, but then my laptop was not behaving properly. So in this particular presentation, most of it would be a result of the literature that I have read. As regards emerging financial markets, for the last 3 or 4 years, very much from the point of view of industrial organization. And it's about time that the three of us, including my thesis advisees, but now my professional colleagues, Ella, Micha, and myself, to start linking our findings on bank competition and concentration, as well as efficiency. I have already included efficiency in the study and financial stability with the Philippines as an emerging financial market. And thus, what I will do is that, so this is the content. These are the topics that I shall cover. What are the emerging financial markets? And then I shall zero in on the emerging Asian financial markets. And then I will go back now to what is closer to my heart, bank stability. But I shall of bank financial markets, and thank God, lately I was able to get literature, very important literature dated 2022, and then make comparisons. And even with that literature, I was able to get comparisons. So for this paper, I didn't do new calculations. Well, we just updated the data until 2019. So I'm actually going to present some things which had we already presented last year, especially on bank stability and efficiency. The new thing that I will do is that I will compare that with the results with the other countries, as far as their bank stability indexes are concerned. So emerging markets, this is the simplified characterization of emerging markets I could find in the internet. An emerging market economy refers to a country that is in the process of developing its economy to an advanced state of development. And it generates low to middle per due to high production levels and significant industrialization. And these are the characteristics: rapid growth, high productivity, increasing standard of living, transition from a closed and open economy, macro stability, volatility and vulnerability to external shocks. Actually, in our presentation, this is what we are trying to attack. Educational quality and investment opportunity. So there's another one that we are actually going to zero in for this morning. The countries with an emerging market, only some of them. I know that there's more, but I highlighted the red ones because they refer to Asia. So India, of course, BRICS, they have been there for a long time. India. And then the next 11, I have data on Bangladesh. As far as the readings I've seen would include Bangladesh, Indonesia, Pakistan, even the Philippines, of course, South Korea and Vietnam, and of course, Malaysia, Thailand, and Sri Lanka. The information that I have, these are the countries which are there. And also I have greater familiarity because they belong to our continent, Asia. So I focus on the financial sector. So I was able to get this literature. The author is Malik with other co-writers. They were actually doing a study on conventional and Islamic banking. So I was happy to be able to get this literature, very recent, 2022. It had just come out, and they actually were looking at stability of the conventional banks as well as the Islamic banks. And I would not be able to do any study on the Islamic banks because I'm not familiar with their operations, and the data is not readily available to me. So that's why I use this particular literature. So why focus on finance? The financial sector is considered an important component of the economic expedite for high-yielding projects through the financial intermediation process. So that's where the banks come in and can ensure the efficient allocation of financial resources between borrowers and lenders. So here at this stage of our study, we are really looking at the state of stability of financial intermediation and specifically our banks. And here, we could see from this paper that financial inclusion and financial stability are foremost. They're very important components for the study of emerging markets. Sorry. And at the bottom of the slide there, I just included the Z-score. That is just a very simple index. It's you just get the return on assets of each bank, get the equity to assets or capitalization ratio, add the two, and then divide it with the standard deviation of the return on assets, the indicator. Now the standard, one of the standard computations for the Z-score, many choices, but the studies that I am using is using this particular computation, using return on assets. It has its limitations. Another computation would be return on equity, but I would like to compare their results with what we have. And then financial stability, I mentioned, this is achieved when the financial system functions efficiently and effectively without interruption. And the financial risks, which we are trying to look into as well, are measured and sufficiently controlled to minimize the impact of systemic crisis. So that is the main goal of financial stability. And we look at that with the Z-score. And we can look at the Z-score like a normal, it's like the normal index. A rate of 2 is good. A rate of 2 is good. Better than 2 is even better. 1.7, you're already nearing 0, so you need a little bit of a buffer to be able to increase it to 2. So that is it's a very good index and it's easy to remember. And then financial inclusion is achieved by providing access to financial services. So FI, or financial inclusion, means that every adult in the population has access to financial services at affordable costs and designed according to their needs. And this next slide is the more interesting one. Why? Because Malik and Al was across all the countries that they are studying, they realized that 33% of the firms among the countries that they studied have access to a line of credit and loans. That's fairly small, 1/3. And then 27% of the population, that's even worse. That's less than 1/3. That's just close. Has bank accounts. I remember in the Philippines, I was able to see 40%. That was pre-COVID. So I think we are a little bit better off, and still 40% is low for us. But for other countries in the study of Malik, 27%, which means more than 1 billion adults have no access to formal financial services. So that's why we really do have a problem in our region, emerging Asia, that is for financial inclusion. And then, of course, with the tension between US and China, this has weakened domestic investments in Asia. And last, financial inclusion can positively affect economic growth and reduce poverty. We know this, enabling the underdeveloped portion of the population access to financial institutions. Thereby, the reason is that thereby, to create assets, accumulate savings for protection against risk. This is for that particular population, that portion of to invest in productive projects. That's the main goal of financial inclusion in this particular type of study and for emerging markets. So here, I've been looking at financial inclusion before. In fact, that was my first step to looking at the financial industry. And I was looking at microfinance, and financial inclusion was a very important, a very, very important issue. And right now, I see it again when we're looking at banks, universal and commercial banks. It continues to be an issue, for emerging markets. emerging financial markets. So now we go to the emerging Asian financial markets, and I zero in the role of banks. Governance quality. So they incorporated governance quality, 3 indicators, no? In the development of financial system, policymakers and public institutions focus on banks, such as central banks, commercial banks, and any country related. In any country, whether they've been emerging market or not. Banks are a major driving force in the modern economic system and are crucial. No, they are crucial for long-term economic growth. Additionally, the economic sectors are highly dependent on the banking industry for working capital investment funds. And any disruption in the banking industry highly affects the economic system. No? And here, this is now, we could see, no, the indicators that they used, no, that Malik and used, no, for governance quality. For example, they got index on voice and accountability, political stability, government effectiveness, regulatory quality, rule of law, control of corruption. And then for financial inclusion, number of commercial banks per 100,000 adults, number of ATMs, institutions of commercial banks, outstanding deposits, loans, the Z-score, no, bank credit to bank deposits for financial liquidity, GDP growth, population growth, broad money. In other words, these are the usual indicators, no, that are used in these types of study that links bank stability, no, with risk. And then these are the countries. There are quite a lot. So among the countries that I mentioned a while ago and enumerated in my list, they're all here. So you might say, hey, Jovi, why are they including Singapore? Why are they including Iraq, Israel, Japan, etc.? No? Why are they including Korea, etc.? No, because wow, are they emerging? They have already gone. They have already achieved. No, they're developed. Okay, this is the idea among these authors. No, so they incorporate all of them into the data file, and then afterwards with the necessary computations, and then after that they remove them one by one, then try to see how those emerging countries are affected of those, so that in the end the results will just have the emerging countries. Okay, so what were their findings? Now, the study finds significant results about the relationship between governance quality, financial inclusion, and financial stability overall. But for Asia, so that's us, governance quality and financial inclusion have a significant and positive relationship. So that's governance quality with financial inclusion. But governance quality to financial stability, and financial inclusion and financial stability, those by partners, no, by indexes, have a positive relationship. But when it comes to governance quality with financial inclusion, negative. No, why? Because of the presence of rigid policies and bureaucracy. So those things that we have seen, first day, which we see as problems that we have in the Philippines, which we know that the NEDA is actually also trying to see what can be done, is a problem across the emerging Asian financial markets. So it's a problem in this part of the world. And so with that, if you notice, financial stability already starts coming in, right? It starts coming in, and that's where I link. No, it's in the Financial Stability Index that I link our findings on bank stability and emerging financial markets. No? Because it seems that, fine, you have the industry organization approach to looking at banks and trying to see, given their behavior, as what are their policies as regards loans, how do they act with this, and then with respect to whatever return is the together is an IO approach, industrial organization approach. But for us, we have to think bigger and look at that behavior in terms of those banks being in a country like the Philippines, which is an emerging market. And apparently, that's also being done even in the other countries. I have seen studies of an IO style, no, input industrial organization style, and linking those results with emerging markets, no, financial markets. And so you start looking at these indicators of industrial organization, market behavior, market power. Then you have the competition slash fragility relationship, or is it competition stability? Okay, so you would be surprised that the results that's happening to the Philippines isn't exactly what's happening to these countries which have Islamic banks. No? And then connect that with stability and efficiency. Again, I myself am okay. That's why I even put a question mark, no, because it doesn't seem to be present, no, in the other countries with Islamic banks. And there, the selected countries that I chose, actually, it's Malaysia, Indonesia, along with countries which have Islamic banks, no. So, but that study has them together, has the results put together, no. It's a good thing that I was able to see a study that's just Malaysia. And then, of course, for the Philippines. For the Philippines, I use our results, no. So of course, in terms of sample size, they would differ a lot, no? Because these particular studies, these authors of the studies on Islamic banks and conventional banks in Islamic countries had access to a huge, no, huge database, especially those authors who did it for across Asian countries, no? For Malaysia, they had access to the database for the commercial banks, no? Smaller banks study, we didn't have that access. Well, we have open access, but then, of course, you know very well that we don't have access, no, quality data sets, no, for the rural banks, no, it's not seen all together in the BSP, no, website, no. I guess it's something that has to be asked, no, but just the same, we had time only to look even just at what is available for the universal commercial banks, and that's all in all about 44 in the BSP database, but we are only using 20. Why is it so? Why 20? Because in the latter years, like in the past 4 or 5 years, there's a change now in the ranking, no, in terms of asset size of the banks. So we had to get the latest, no. So what we're using now for 2019 would be the latest top 20. So competition fragility, what does it start saying? Too much could simultaneously prompt additional innovation in the products offered, making the banking system more fragile. So that's the reason for competition, high competition, but at the same time, banks making themselves vulnerable to fragility because they have to offer different types of products in order to get that demand from those who want a loan. But this competition could lead to a decline in the bank profits and the dissolution that can lead the banks to face more challenges to keep up the benefits. Now, here, the next one is competition stability, because what we saw is that there's a need for just enough competition. Okay, not too much competition, just enough. In effect, we're trying to see the reality, no, of having dominant and fringe banks, which puts us to a loose oligopoly situation. No, just enough competition, big banks, no? And some of our big banks are getting, no, the small savings banks. They're merging with them, no, but that's okay. That allows those banks to be more stable. So just enough competition, enabling banks to achieve profits and increase capitalization, making them more stable. So that's that partnership now, competition stability vis-a-vis competition fragility. But the more important partnership of indexes is stability with efficiency. No, and this is, I'm very thankful to my student Ella Leonida. No, she was the one who took off from my study, from my dissertation. So again, she takes off from just enough market power, but achieved with innovative products and cost-efficient operations. So this is the conceptual framework that I was telling you. No, competition, stability, efficiency nexus among universal commercial banks that they go seeking. So financial stability is the link of the industrial organization indexes with an analysis of emerging markets. These are the results. Look at Malaysia. The general discovery from this research is that banks face extra risk exposure when an increase in banking rivalry is found in the market. Besides, Islamic banks might face a different relationship than conventional banks in terms of return on assets, since no change is found in the impact of competition on return on equity and the Z-score. The Islamic banks might follow traditional. So that's the no paradox, no? They might follow traditional banking operations that have diminished the distinction between Islamic and conventional banks. Why? Because what is the score? What is the core of Islamic banking? No, profit sharing. But they're realizing that that type of relationship is highly risky. So the banks end up giving loans, but at a premium. They'll follow the practice of traditional or conventional banks. So that's the problem with the Islamic banks. No? So they have problems now, even with that, what I characterize, they have a problem even with efficiency, because it seems that this profit sharing method is not making them cost efficient. Sorry. Okay. So now the paper, which looks at many emerging markets, that includes Indonesia, Bangladesh, and Malaysia. Actually, we're also included here in this particular paper. No, it's done by Kabir and Worthington, 2022. So I'll just read the green part, the green shaded part. In terms of results, they reject the competition efficiency hypothesis. So imagine, so the study in Malaysia, I didn't anymore read to you, but that is the result. Given the problems that they're having on profit sharing, they're having problems also with cost efficiency. No, so particular competition efficiency hypothesis partially accept the efficiency stability hypothesis and reject the competition stability hypothesis for both banking systems. So we first find that market power significantly increases efficiency in both banking sectors. However, it is of a higher magnitude for Islamic banks. Thus, we reject the competition efficiency hypothesis. We can then find that efficiency positively affects the stability of conventional banks, but has no significant impact on the stability of Islamic banks. In effect, in other words, what we're saying is that the competition, stability, efficiency nexus seems to be seen among the conventional banks. For these types of countries, which have an Islamic bank, a strong Islamic bank system, but the Islamic banks do not have that nexus of competition, stability, efficiency. And so,
Excuse me, Jovi. Excuse me,
yes.
Jovi. 20 minutes are
Yes.
up already. If you can wrap up
Yes.
quickly.
Yes,
You.
I'll wrap up. No, so this anymore. So see now is we confirm the role of having big banks, having big banks, but at the same time we also have fringe banks. So together, both big banks and the fringe banks are able to increase their capitalization. All of them are increasing their capitalization, and at the same time are able to operate with efficiency. And here, when I say efficiency, cost efficiency, because in the moment of expanding, they have to incur costs. Definitely. But then at the same time, they're able to make their operations efficient, because as we have seen, meaning us, we have seen that all of them had increased substantially their capitalization in the last 3 years, which was not true when I was defending my dissertation in 2017. So they were still trying their best to and now we're already reaching more than 16%, because with 16% capitalization, they have a buffer. So anyway, these are the quantitatives, And conclusion: the full potential of emerging financial markets is realized in the presence of financial inclusion, financial stability, and high quality of governance. And the competition stability efficiency nexus enhances the financial stability of emerging markets. And there I end my paper. These are the most important references. Thank you so much for your patience.
Thank you, Jovi. So let's go immediately into the open forum. I think there were some questions already typed in. So let me get to that first. There was one question on from Banco San Vicente, and if I read it, I think this is for the first paper. Hi, Christine and Ethan. Do you also have like insights on the adoption of other financial services other than e-wallets and payments? For example, do you observe increase in lending, loan portfolio, remittance transactions, crypto? So with Ethan, or I think si Kathy yata ang referred. So it's hi Kathy and Ethan, I think.
Yeah, sure. All right. So for that question, I think essentially the general trend for a lot of these digital financial services has been on the uptick, precisely because of digitization being so rampant in the country, and with the country also boasting a population that is largely unbanked, meaning the market potential is still readily available, and any service that provides, an improvement in the way that Filipinos can bank online or can do their financial services is very much welcome. And we can see this in across the different services that we presented in our presentation, which include lending, remittances, crypto. For example, in lending, according to a TechWire Asia survey, we see that there has been an increase in demand for online loans of about 75%. Digital banks have also been increasing in proliferating in the market, allowing for 200,000, I think, depositors in less than 1 year since 2021, meaning with the rise of digital banks, there is also a rise in digital financial services. Once again, just highlighting that general uptick in financial services.
I can further add into that and looking into a different perspective. Like, for example, the ones that we discussed a while ago were financial services within the commercial banks and also e-wallet providers such as GCash and PayMaya. We can see that some commercial banks and also e-wallet providers have already expanded their financial services, including lending, remittances, and also crypto and stock trading. So, for example, in lending, we could see a lot of commercial banks and also GCash and PayMaya expanding to microfinancing or MSME financing, G loans, and also like save now, pay later schemes. And then we could also see different partnerships within remittances from international and domestic institutions, like for example, Cebuana Lilier, Western Union, etc. Those institutions domestically and internationally, like for example, Dash, Alipay, etc. They're paving the way in order to broaden or make remittances much more accessible by providing these services in commercial banks and also e-wallet providers. Like for example, one new latest news is that GCash is also expanding to Singapore. Like they were able to partner up with different corporations in Singapore, particularly Dash and Alipay. So that's why we're able to use GCash when we go to Singapore with the so-called services. And lastly, with regards to crypto, actually recently Union Bank already launched or is planning to launch their crypto trading platform, and this was also partnered with an international tech company. From what I remember, it's Metaco. So this platform by Union Bank is called Harmonize. So they're able to be trading Bitcoin and Ethereum, etc. And this is very new because, as mentioned, the Marcos administration wants to explore much more opportunities with regards to blockchain technology. And this is a step towards that. And in general, there's already a very established crypto. I mean, there are a lot of Filipinos who are making use of cryptocurrency. Like for example, in the famous game Axie Infinity, statistics show that 40% of the customer base or the user base are from the Philippines. So that just says that there's a lot of potential with regards to establishing these kinds of financial services within the Philippines because there's a demand for it. And especially if it becomes much more accessible through partnering up with already existing traditional institutions and new digitalized institutions. So yes, thank you.
Thank you. Please type in your questions, or if you're familiar with Zoom, you can also, I think, raise your hand. Here's a question from BSP, Hazel Parcon. Hi, Dr. Dakanay. May I know what year's period were covered in your study and what regression technique did you use for your methodology?
Yes, yeah, I didn't anymore do that. Year, no? 5 up to 2019, And for all the regressions that we have done, myself, even with my student, Ella, on efficiency, we use the generalized method of moments. So that was what we used. And we used the BSP data. So 2005 to 2019 quarterly. And top 20. Thanks.
Thank you, thank you, Jovi. We still have a few minutes left, actually about 5 minutes, in case there are further questions. Yeah, personally, I was curious also about the first presentation. There was mention of I think mainly GCash and PayMaya is what comes to our attention. I was wondering how big of the whole, what percent actually of fintech does GCash and PayMaya account for? Because I noticed in your presentation there are a lot of other sectors in fintech. I mean, either Ethan or Kathy.
Sure, sir. I think that's a little difficult to compute because GCash and PayMaya have also become sort of like super apps in that they're combining a lot of these different financial services within a single platform. So then there are overlaps between, say, payments and say lending, because GCash also provides lending services, but then another application can provide, or another application's sole business model would be, lending. But in terms of, I think the general usage of Filipinos across the country, I think it is reasonable enough to say that GCash and PayMaya will continue to dominate, precisely because they are diversifying their services and because they have already established themselves as strong leaders in the market.
Okay, thank
Also,
you.
I also add into that. I guess since we don't have any it's very difficult to provide a percentage on how much in the population uses GCash and PayMaya in general, and even the other e-wallet providers, is because there isn't much data that's being published with regards to all of those. Like, it was very difficult actually for us to find. But I guess one proxy that we could use is how many active accounts are already there in terms of GCash and PayMaya. So from what we know, as of like the 2022 data, GCash already is over 60 million users. So that's a significant growth before, because what we reported from 2020 was around 44 or around 40 million, etc. Meanwhile, for PayMaya, they have over 45 million already in terms of for this year. So that's a very considerable increase, especially for PayMaya, because they recently relaunched their platform just this year, early part of the first quarter. And from their reports alone, they said that there was at least 1 million increase already in customer base within the months reported already. So yes.
Thank you. We have a question here from Dr. George Manzano for Erwin, the paper on trade. Wish to thank Dr. Cruz for presenting the interesting paper. Would there be a relationship between the growth of LTG exports with pre-EU GSP tariff rates? In other words, can the growth rate of LTG be attributable to the lifting of tariffs due to GSP, or there might be other factors in play? Perhaps contrasting the LTG with a control group of non-GSP, non-FTA partners might be useful. Would you have any comments, Erwin?
Yes, Dr. Manzano, thank you for that comment. I actually rather hesitant saying that, hey, GSP Plus was responsible for for these exports, because there are other factors in play, possible factors in play, right? And also, like, for example, it would have been good to have that control group, which I actually do not have time to do. And also, but it's a good, that's important to provide how do you say this, a comparison, basically a control group. But I really want to, my intention was really to find the evolution of this how do you say, this particular set of export products from the Philippines during the given how to say, given a period. And perhaps yes, this is the next step for that, for this paper.
Thank you, Erwin. And unfortunately, I think we have to end it there because the next session of what do you call this, workshop presentations will begin at 10. So to give everyone a chance to find the link for the next sessions that you want to go to, we'll end this session here. Let me give our thanks to Dr. Erwin Cruz of Ateneo for his presentation, and also for Dr. Joby Dacanay and Mr. Ethan Lee and Ms. Catherine Salazar for presenting to us this morning their papers. So with that, I'll close this session, and I hope to see you again. Sadly, the PES 60th PES is coming close to ending this last day. So hopefully next year we'll be able to see each other again in person. So thank you, everyone. Thank you also to the Secretariat of the PES for having helped us set up this session here. So goodbye to everyone. See you again soon. See you, Erwin. We have to get together.
Hi, Erwin.
See you.